Welcome to our presentation on banking regulation and its impact on stability. Well, to begin with, what is bank regulation? It consists of principles, codes, or standards of conduct that govern the behavior of financial institutions. It ranges from formal legislation to supervisory guidelines and statements of principle. The core codes of banking supervision include several key components such as licensing and structure. This defines what activities a bank can perform, and this also assesses the integrity of its owner's management. Secondly, there's the prudential requirements. This is about setting minimum capital adequacy standards, so banks have a cushion to absorb losses. There's the risk management, which is pretty obvious, and there is the KYC, know your customer. Those are rules to prevent the intentional or unintentional use of banks by criminal elements. Lastly, there's transparency, with which is meant the requirements for banks to provide information on derivatives trading and other complex financial activities. Now, why are they necessary? Why is bank regulation necessary? Well, mostly because banks are where the money is, and their failure can have huge catastrophic effects on the broader economy. But also to maintain financial stability. The primary function is to maintain the overall soundness of the financial system, rather than just monitoring individual transactions, as well as to prevent crime. Regulations like anti-money laundering codes are designed to restrict drug trade and terrorism by preventing the criminal use of the banking system, as well as to protect taxpayers. Without regulation, banks may take reckless risks, knowing that taxpayers often have to foot their bill for expensive bailouts. Another reason is to correct market distortions. Banks often do not bear the full costs of the risks. Regulations forces them to internalize these costs so that talent and resources are not wasted on unproductive, high-risk activities. Lastly, to preserve public confidence. If the public perceives banks as being associated with criminals, then obviously confidence in the entire system can be undermined and will be undermined, leading to instability. Now, who regulates the banks? Well, there's two levels on which banks are regulated. There's a national level, where there's specific agencies like the central banks. In the US, it would be the Fed, the Federal Reserve Bank, or Bank of England here. There are supervisory offices, and there's finance ministries or treasuries like the US Treasury. On the international level, there's global organizations such as the Basel Committee on Banking Supervision, about which my colleague will tell you more on. And there's the International Monetary Fund, IMF, and the World Bank, as well as the Financial Action Task Force, the FATF, which is an independent body focused specifically on combating money laundering and terrorist financing.
So we're going to continue with overview of major banking regulation, starting with three Basel Accords developed by Basel Committee on Banking Supervision. So first one is dated 1988, and it has introduced minimum capital adequacy ratio of 8%. So this is the relationship between bank's capital to its risk-weighted assets. This capital adequacy ratio ensures banks hold enough capital relative to their risks, reducing the likelihood of failure and therefore promoting financial stability. It also focused mainly on credit risk, and it was simple but lacked risk sensitivity. So moving on to the second one, dated 2004, it introduced three pillars framework: minimum capital requirements, supervisory review process, and market discipline and transparency. So full disclosure of financial risks and therefore information. It expanded to market and operational risks and also encouraged internal risks models to ensure more flexibility. The last one strengthened common equity tier CET1 capital and also introduced liquidity coverage ratio, which is the relationship between high quality liquid assets and net cash outflows over 30 days. And it must be higher than 100%. And it also added capital buffers, so extra capital requirements above the minimum CAR that banks must hold in good times, so no crisis times. Let's move to the next act. This is a Dodd-Frank Act. This is a US version, is 2010, and this is a crisis response. So it's introduced after the 2008 global financial crisis with the target of reduction of systematic risks and too big to fail problem, since during this crisis, a lot of big banks also failed. And here are the key elements of this act. First one is Financial Stability Oversight Council. So government formed a committee that monitors systematic risk across banking institutions. The Volcker rule that restrict banks from speculative trading with own money, so therefore less high risks, short-term actions on financial market for banks. The stress testing procedure that ensures bank can survive economic shocks. And the last one is regulation of systematically important banks. So as we can see, after the Dodd-Frank Act passage in 2010, the amount of credit card loans, auto loans, and purchase mortgage loans rose significantly. And that means that increased oversight of large banks, reduced excessive risk-taking behavior, and improved transparency and accountability for banks. So therefore, compliance costs and regulatory complexity increased. So people started to believe in safety of their deposits more. And we can see this positive statistics provided by New York Federal Reserve Bank and other sources. So moving on to supervisory framework in the UK and European Union, starting with UK regulations, they introduced Prudential Regulation Authority, PRA, that ensures financial soundness of banks, then Financial Conduct Authority that protects consumers and ensures fair markets, and they both operate under the Bank of England. Moving to EU, European Central Bank was created that supervises major banks via a single supervisory mechanism and also works with national regulations across EU countries. So also mentioning the connection between the UK and EU post-Brexit, there are like coordination challenges, but still both banks operate like together.
Thank you, Misha, for explaining this. Now let's see the impact it has on banks. Let's move from the theory of regulation to its tangible reality. First of all, capital requirements create the central tension in bank management. Equity is both the first line of defense against insolvency and the most expensive line on the balance sheet. Holders demand a premium that depositors never would. When Basel III forces higher capital, the equity multiplier compresses and ROE takes the hit. The response comes down to the three levers. Either expand ROA, squeeze more margin from the asset side, reprice loans, originate higher yielding but not yet penalized risk, or shift fee income from wealth management or investment banking to lift returns without growing equity. They can also shrink the balance sheet, trim low-margin assets, run off portfolios, or de-lever until the multiplier recovers and ROE satisfies the market, often the quickest fix. Or they can also manage the constraint. This isn't a one-time trade-off. It's a continuous calibration between regulatory thresholds and cost of equity. The banks that do it well treat capital as a scarce resource to be allocated, not a compliance hurdle. The problem is capital requirements are static, whereas stress tests are dynamic, and they've become the binding constraint for large banks. Regulators simulate a severe crash. For example, GDP goes down 5%, unemployment at 10%, house prices off 30%. The bank must prove it survives. Failing is a catastrophe. It signals weakness to the market in ways a low capital ratio never would. That credibility changes behavior. Banks don't just aim to pass, they structure the business to pass. They can de-risk, so shed non-core assets, cut volatile trading, reduce concentration, or they can run for resilience. If a business line fails the test, it gets shrunk or shut down, regardless of the standalone profitability. Or they can even shift from ex-post cleanup to ex-ante prevention. So they can prove you can survive the crisis before it happens. So stress testing isn't a compliance exercise, it's the framework that sets strategy. Now, Basel III demanded three requirements that drove the transformation: higher capital, CET1 minimum of 4.5%, liquidity rules forcing banks to survive 30 days of stress, and a 3% leverage ratio to cap balance sheet growth. The first consequence is capital strength. In 2008, JP Morgan's capital base was 330 million euros. By 2023, under Basel III, it had grown to 41.7 billion euros. The Common Equity Tier 1 ratio, which is the highest quality capital, stood at 19.96%, nearly double the regulatory minimum. The second consequence is liquidity restructured. Basel III's LCR fundamentally changed liquidity management. In 2008, the bank held essentially zero central bank balances. By 2023, it held 63.7 billion euros and reported an LCR of 149%, which is well above the 100% requirement. The third consequence is profitability suppressed. In 2008, the bank reported a normalized return on equity of 15%. Under Basel III, ROE fell to 6.8%. This lower return is the direct cost of holding more high-quality capital and liquid assets. Now, the ultimate consequence is business model constraint. In 2008, the bank had no active trading book. In 2023, trading assets reached 210 billion euros. This expanded business is now governed entirely by Basel III's constraints, with the bank explicitly prioritizing its fortress balance sheet. So from 2008 to 2023, JP Morgan's capital grew 126-fold, liquidity transformed, and the balance sheet expanded from 16.7 billion euros to 421 billion euros. But safety came at a price. ROE fell from 15% to 6.8%, the fundamental trade-off of Basel III.
I'll discuss the key challenges of banking regulation, focusing on innovation, regulatory arbitrage, and systemic risk. Does regulation hinder innovation? Higher capital requirements reduce leverage and lower return on equity, which weakens incentives for innovation. Compliance costs also increase, making it harder for smaller banks to compete, leading to market concentration. However, regulation improves transparency and confidence, supporting long-term stability. It also encourages the growth of fintech and non-banking institutions, some of which operate in the shadow banking system. The non-bank financial sector has grown significantly, reaching around $239 trillion in 2022, or around almost 50% of global financial assets. Within this, shadow banking accounts for around 67 trillion. As shown in the graph, non-bank financial intermediation has increased over time, highlighting how financial activity is shifting outside the traditional banking system. This reflects regulatory arbitrage, where stricter bank regulation pushes activity into less regulated sectors. As a result, risk is not reduced but shifted to less regulated areas. Risk. Large banks are considered too big to fail, meaning governments are likely to support them in crisis. This creates moral hazard as banks take more risk, expecting bailouts from the government. It also leads to market distortion and costs for taxpayers. Then, despite the reforms, this problem remains a key challenge in financial regulation. Overall, regulation improves stability but also creates new risks through regulatory arbitrage and moral hazard.
Throughout this presentation, we have examined how bank regulations evolve from things like Basel I to Basel III, and how these reforms shape financial stability and risk-taking in practice. So, to conclude, banking regulations has improved, yes. It has improved financial stability, but it has not made the system fully secure and has had trade-offs in the process. The clearest lesson from the post-crisis period is that regulation has made banks more resilient than they were before 2008. Stronger capital requirements, tighter liquidity standards, and leverage constraints have reduced the fragility that made the financial system so vulnerable during the global financial crisis. As mentioned earlier, the JP Morgan AG case study showed clearly that post-crisis regulations strengthen resilience in practice, not just on paper. However, this stronger stability came with real trade-offs. Higher capital and liquidity requirements reduce the probability of failure, but they also lower profitability, reduce flexibility, and make banks more defensive. In other words, the system is safer, but not at a cost. That leads to the second question. Are current banking regulations sufficient? Our answer is yes, but not fully. One reason is that regulation is strongest inside banks, but financial risk does not stay inside banks. Tighter rules can push activity into less regulated areas, such as non-bank finance and shadow banking, where, based on a statistic I read, $70 trillion is invested in things like private equity and fintech, meaning that risk may shift rather than disappear. Other issues is that financial system may continue to evolve. New forms of stress, liquidity pressure, and interconnectedness can emerge faster than regulation can fully adapt. So regulation can improve resilience without eliminating vulnerability altogether. Finally, strong rules still depend on strong supervision. Financial stability depends not only on regulation existing, but on regulators and central banks being able to monitor risk, run credible stress tests, and respond effectively when pressure builds. So, the overall judgment is that bank regulation has materially improved financial stability, but still perhaps there are some incomplete patches. It has made banks safer and reduced the likelihood of a repeat of the last crisis, which is very, very important, but it has not removed the systematic risk entirely. Thank you very much.